this is a chock full of catalyst type scenario. Should investors change their course based upon any of these potential catalysts, or are things relatively stable with markets near record highs?
Well, good morning, Dom. Great to see you again. I do think it's important to stay the course here. We do expect some volatility in coming weeks. As you mentioned, there are a number of catalysts unfolding. The election creates some uncertainty. The timing of Fed policy creates some uncertainty. But we think the path forward will be led higher by earnings. So earnings season has been okay. Our outlook for next year is for an improving earnings outlook, mainly on the basis of better profit margins. So companies are going to have to work hard here with this slowing economy. We do think there will be some volatility in coming weeks, but it's important to stay the course and be patient in the weeks and months ahead.
The ones that matter, Robert, are the Magnificent Seven stocks because they provide the bulk of the earnings growth in the S&P 500. But there's a lot more focus on some of the other names these days. Are we going to continue with this broadening out theme, or are we going to focus on the names that actually generate the growth in earnings?
Well, for now, as you said, there's been a lot of focus on tech. They do have the consistent earnings. That's important. It's important not to abandon that area of the market. We do see some broadening in the quarters ahead. Part of that is with the interest rate cycle turning a bit lower. That alleviates some of the financing risk that you typically see in smaller companies. And the second part of the catalyst is we expect these gains in profit margins to start expanding through larger segments of the market. So some areas have seen improving profit margins already on the basis of productivity gains, and we expect that to broaden out, leading to higher earnings through a much wider segment of the market in the quarters ahead.
The interest rate picture is one that is going to drive a lot of the market narrative going forward, but so is the election, so is the outcome, so is the forward-looking forecast for what it could look like with certain scenarios developing. I'm curious what your base case is and whether or not you think rates change because of that.
Yeah, well, our base case right now is pretty close to consensus, which is for some form of divided government. Typically, even if you have a single party control, it takes time to implement legislation. So no matter the results next week, we have some time until inauguration. You have time to craft policy, time to get that policy implemented. And so we think there's a period of time here where, yes, there's a lot of uncertainty, but it takes a while for these changes to get implemented. As far as how it relates to the yield curve and interest rates, I think some of the move higher in rates has been more from disappointment from investors of how slowly the Fed is likely to move. There was a lot of enthusiasm over very quick cuts, especially after the 50 basis point move. And now there's an awakening to the reality that the Fed's likely to move very slowly, and that probably keeps some pressure on yields for a while.
And just one quick question before we leave, Robert, the favorite sector you have right now?
Yeah, so we like technology and healthcare as areas that have the potential to really control their destiny through growing profit margins.